Hey, hi everyone. Hi. Okay, for those on Zoom, let me know. Can hear you, see the screen. No video, but not an issue. Not sure what was happening, but yes, everything seems to be working now. Okay, so it should say central banks versus inflation. Today's the 2nd of December, and your speaker today is me. Thank you, Gula. Thank you so much for letting me know. Okay, I will start with our webinar today. Okay, hi everyone. Welcome to today's webinar brought to you by Vantage, right? So we're gonna do central banks versus inflation, another macroeconomic topic. Today's the 2nd of December. I hope whatever I share is insightful to you guys. Okay, just give me one more minute. I just need to let Vantage know that everything's working fine and then we can continue. Okay, cool. Um, Before we start with today's webinar, I do need to, as usual, touch on the disclaimer. Basically, the disclaimer is just a reminder to you guys that this webinar is purely educational. Nothing that I share in this webinar should be construed as investment advice, financial advice, or any form of signal to buy or sell. Okay? This is purely educational, or what I like to say is just being able to see from a different perspective from a different trader. Okay, so please do not take this as a signal, and just a friendly reminder, trading Forex and CFDs, especially if you are trading on margin, carries significant risk and may not be suitable for all investors. And not even may not, it is not suitable for all investors, okay? Especially people who don't really have discipline. Okay. It's not just trading, it's anything in life. If you don't have discipline, you are going to get burned. Okay, so please be careful. I do have to stay here for a minute or two so that you guys can slowly read through the disclaimer. So yeah, we'll stay on this slide for a while and then we can start with today's webinar. Okay, cool. That's about a minute already. I think everyone should be done reading through the disclaimer, but again, it is purely just a reminder that um whatever I'm sharing in this webinar should only be construed as trading, be construed as educational and not any form of trading advice. Okay, I don't know why. I don't know why the Vantage app is acting wonky and my video is in the middle of nowhere. I don't know if that's better. I'm putting myself in the corner. Okay, there you go. Okay, I'm gonna introduce myself for those who don't already know me. I mean, let's see how many of you. 1,200 of you today. 1,250 of you today. Welcome to our webinar. Okay, for those who don't already know me, my name is Cassandra. You guys can call me Cass. I am an investment analyst at Everest Fortune Group, which is a research firm that is based in Singapore. Okay, so what we do at this research firm is basically a lot of backtesting, a lot of forecasting, a lot of research, understanding the markets, we're basically just studying the markets in and out. Okay, that's basically my day job. We have been recognized as the finalists for the best forex and the best equity research for multiple years running. So we're not just researching stuff, we're not just Googling stuff, we're really going into in-depth research of the markets and the economy. Okay, other than that, I am a prop trader. What that means is I am funded by multiple companies. I'm funded and then I trade their funds. How did I get this funding? Well, you have to pass their test. Okay, to pass their test, you have to do 10% profit within a month to get certified and to pass their test. And I've done that multiple times already. Doing 10% a month is not that hard for me. Maybe because I study the market so much that I kind of understand it very thoroughly. I use a lot of technical analysis to get to that 10% profit. Other than that, just because I'm someone who is profitable today, it doesn't mean that I will be profitable forever. I know someone who's like managing a huge fund in a hedge funds, whatnot, and ended up still losing their account and losing millions of dollars. So I'm profitable today, but it doesn't mean that the markets is not changing. The markets is constantly still changing, and my job is to adapt to the market as much as possible. Therefore, if you guys have any questions for me, do ask me in the chat box, anything at all. It could be technical analysis, it could be fundamental analysis. It doesn't have to be related to today's topic. As long as you have a question regarding trading and how to be profitable, just ask me in the chat box and you don't have to worry about delaying the webinar because a lot of my topics, I can finish it in like 30 minutes and the rest of the time I try to use it to answer some of your questions. I try to use it to, see where you guys have challenges that you cannot overcome. Okay, so let's talk about agenda for today. How central banks control inflation and growth. The Fed, ECB, and BOJ, same goals but different playbook. How interest rate decision moves forex pairs and trading high yield versus low yield currencies. Okay, give me a minute. I just need to double confirm that we are on the correct topic today. Yes, we are indeed on the correct topic. Okay, cool. So let's start with how central banks control inflation and um, growth. Okay, so okay, need my notes. Okay, so when we talk about central banks, right, and inflation, we're talking about one of the most powerful relationships in the entire financial market. Okay, central banks exist for two main reasons: to keep prices stable and to support the economic growth. These two goals sound simple, but in reality, they constantly fight each other. If inflation is too high, okay, the central bank needs to cool down the economy by raising interest rates. But raising interest rate also slows down business activity, reduces borrowing, weakens consumer spending, and puts pressure on credit markets. On the other hand, if the economy is slowing down too much, like during a recession, central banks cut interest rates to stimulate growth. So you can imagine central banks are always trying to balance the temperature of the economy like a thermostat. They have a few tools like this for this. The most obvious one is interest rates. Raising them makes borrowing more expensive, which slows spending and cools inflation. Cutting them makes borrowing cheaper, which boosts economy activity, and they also have massive secondary tools. Okay, so quantitative easing, which means buying bonds to inject liquidity and push yields lower, and quantitative tightening, which means removing liquidity from the system. Even forward guidance, the speeches they give, can move markets because traders price in the expected path of policy. So every time Powell, Lagarde, or Yunda speaks, okay, the market listens carefully, not because of what they say, but because of what they might do next. So in short, Central banks don't follow the markets follow the central banks. So it is like up until recently, I do realize that it is important to keep note of what the central banks are saying because they will move the market. So it's good to combine both of them with technical analysis. Okay, so now let's look at why inflation forces central banks to act. So inflation is the number one enemy of central banks because it destroys purchasing power. When prices rise too fast, salaries don't keep up. Savings lose value and households struggle with daily costs. But the real danger isn't just current inflation. It's when people start to expect inflation in the future. Okay, so if households think prices will rise, they spend faster. If businesses think costs will rise, they raise prices ahead of time. If workers feel the cost of living is rising, they demand higher wages. This becomes the infamous wage price spiral. And is exactly what central banks fear. Once inflation expectations become unanchored, the central bank loses control and must slam the brakes extremely hard. That's why the Fed raised interest rates at the fastest pace in 40 years in 2022. Okay, not because CPI was high, but because they wanted to prevent long-term expectations from drifting. Okay, so central banks behave like firefighters. They prefer to spray too much water early than to deal with the fire that spreads later on. Okay, so this is why even a small inflation surprise can make central banks react aggressively. And when central banks react aggressively, the entire forex market reprices instantly as well. Okay, so let's look at how central banks balance inflations and growth. One of the hardest jobs for central banks is actually balancing inflation control with economic growth. So raise rates too quickly and you risk triggering a recession, collapsing credit markets and hurting employment. So if they move too slowly, on the other hand, and inflation spirals out of control. This constant tug of war is why monetary policy is never perfect and why central banks often overshoot in one direction or the other. A soft landing where inflation comes down without the economy crashing is extremely rare. So for traders, the important thing to understand is that markets move based on expectations, not data, not just data. Okay. I think expectations moves the market first, although I don't think it is something that will last long, but it definitely does trigger some kind of movement first. So if the central bank signals that inflation is coming down, and rate cuts may be coming soon, risk assets rally, even if inflation is still above target. So if the central bank hints that inflation remains sticky and rates may stay high, currencies tied to that bank tends to strengthen. Okay, the actual economic reality often lags behind the market reaction by months. So when you're trading Forex, gold, indices, for example, your job isn't just to follow the data. Your job is to understand how central banks interpret the data. Because once you understand how they think, you'll understand why markets move. Okay, I'll be very honest, up until today, right? I still feel like I might misinterpret whatever they are saying. Okay, so that's why I think if you guys have met me earlier on, I always say I am not a news trader. Why? Because number one, I don't like staying up until like a certain time and waiting for news to come out. Okay, I don't like that. And secondly, is because I don't sometimes when they say something, I have this fear that I might misinterpret what they're saying. Okay, because what if what they're saying is something I think it's hawkish, or yeah, if I think it's hawkish and then it turns out not being hawkish, okay, because of language barriers, for example. Okay, so I mean, recently I'm trying my best to understand what they're saying more. But yeah, this is something you definitely need to practice and definitely something that you need to master. And yeah, there's a lot of videos out there and there's a lot of information out there to kind of understand what they're saying. So don't be fooled when they say something thinking it's one way, it could be other way. It could be the other way. Because do you guys notice that a lot of times when news comes out, the price tends to like shoot one end and then comes back down, and then you have a super long wick. It could be because the first 5 minutes or the first 10 minutes, people misinterpret or misunderstood what the banks are saying, and then later on, like it's kind of priced in, and then it goes into that correct direction. Okay, so the Fed, the ECB, and the BOJ, same goals, but different playbooks. Okay, we're gonna touch on the Federal Reserve, the aggressive, data-driven, and the most powerful market mover on earth. They move the market very, very fast compared to other markets, for example. Okay, so let's see. So when we talk about the Fed, okay, we're not just talking about um a central bank. We're talking about a single most influential financial institution on earth. By the way, I took this picture from Google, so that's why you see another company's name there. But yeah, um, I'm just using a little bit of their information. Okay, so we're talking about they're very influential in the financial institutions. Okay, so the Federal Reserve sets the tone for global liquidity, the global risk appetite, and global interest rate cycles. This is because the US dollar is the world's reserve currency. I think we all know this already, especially those who are here every single week. I'm sure you guys, this would have been drilled into your head already that US dollar is the world reserve currency, meaning almost every country holds the US dollar for trade, debt, or financial stability. So whenever the Fed raises or cuts rates, the effects ripple far beyond America. Okay, emerging markets feel it, commodities feel it, global equities feel it, and forex markets respond instantly. So the Fed's approach is very aggressive and very data driven. Unlike the ECB or the BOJ, the Fed reacts quickly when the inflation rises because they have a strong mandate to maintain both price stability and maximum employment. When inflation spiked after COVID, the Fed raised interest rates at the fastest pace ever in 40 years. Why? Because they feared inflation expectations drifting away from the 2% target. They don't want consumers and businesses to start behaving like inflation is permanent. Okay, because once the mindset sets in, inflation becomes self-fulfilling and much harder to control. Another unique thing about the Fed is how transparent they are. They use forward guidance, so FOMC statements, dot plots, speeches, and every form of communication available to carefully manage market expectations. In fact, markets often move more based on Powell's tone than on the rate decision itself. You can have a 25 BPS hike, but if Powell sounds dovish, right, the US dollar immediately drops. You can have a rate pause, but if Powell sounds hawkish, the US dollars will pump. This is why the USD pairs, gold and Nasdaq are incredibly, incredibly sensitive to Fed language. Trading the Fed is not just about understanding inflation, it's understanding about the psychology behind policy signaling. Okay, so you need to go and read their language. Like I said, sometimes I might misunderstand it myself, but with time and practice, anything can be mastered, to be honest. Okay, let's move on with the ECB, which is the European Central Bank. It's a little bit slow, it's political, there's fragmented and constantly battling energy-driven inflation. So the ECB operates under a completely different set of constraints compared to the Fed. The Eurozone is not one country. It's a collection of 20 countries, by the way. Okay, I'm going to move my head to the bottom of the screen for those who have Vantage, because I realized the picture is covering the notes. Okay, and these 20 countries have vastly different economic conditions, political systems, and inflation levels. So Germany have strong growth and high inflation, while Italy may have weak growth and low inflation. Spain may have booming tourism, while France may be slowing down. Okay, so when the ECB makes policy, they are trying to tailor one interest rate to multiple economies that don't behave the same, don't have the same characteristics. Okay. This makes their decision much more complicated and therefore slower because there's a lot of things to take into consideration. So when it comes to anything Europe, it's always going to be slower because not too many, so many countries are involved in the decision making. Like I mean, they're not directly involved, but you have to take all these countries into consideration. So another unique feature of the Eurozone is its independence on imported energy. When oil or natural gas prices surge, especially during geopolitical crisis, Eurozone inflation shoots up even if consumer demand is weak. This happened during the Russia-Ukraine war, okay, when energy prices skyrocketed and inflation surged to record highs. The ECB was forced to raise rates, but at the same time, parts of Europe were already showing signs of economic weakness. This is why the ECB often moves cautiously and tends to raise rates later in the cycle than the Fed. For traders, the key insight is that EUR USD is driven heavily by rate differentials. If the Fed is more hawkish than the ECB, EUR USD falls. If ECB surprises markets by being more hawkish, EUR USD rises. You must remember currencies are relative instruments, okay? They move based on comparisons, not absolute performance. And because the ECB is usually slower and more conservative, the EUR often lags behind the USD during inflation cycles. Okay, but when the ECB finally acts, the EUR can move violently because traders rush to reprice months of expected tightening that did not happen earlier. So it's just like delayed information, but it was gonna happen anyways. Okay, so now let's move on to the Bank of Japan. Usually short, we call it the BOJ, but it's ultra dovish, yield curve control, and the world's most controversial monetary policy. All right, guys. Okay, water break. Thank you. Okay, so if the Fed is aggressive and the ECB is cautious, the Bank of Japan is something entirely different. Okay, the BOJ operates in its own universe because Japan has struggled with deflation and weak inflation over 30 years. It means while the rest of the world raises rates aggressively to fight inflation, Japan barely touches its interest rates and instead uses an unconventional policy called curve control. YCC allows the BOJ to keep Japan's 10-year bond yield within the fixed range. If the yield rises too much, they buy bonds. If it falls too much, they adjust the operations. Okay, this artificially suppresses borrowing costs and keeps the yen weak. Japan's problem isn't inflation, it's the opposite. Prices haven't been rising sustainably for decades. Okay, the population is aging, the workforce is shrinking, and the economic growth has been sluggish for years. Okay, so this forces the Bank of Japan to remain dovish even when other central banks are hiking aggressively. As a result, the Japanese yen becomes a funding currency for global carry trades. Traders borrow yen at extremely low interest rates and invest in higher yield currencies like the US dollar, the Australian dollar, the New Zealand dollars. This makes the USD JPY, AUD JPY even, and other yen pairs extremely sensitive to global risk sentiment and interest rate differentials. Okay, the moment the BOJs even hits at tightening, even slightly, the USD JPY can drop hundreds of pips. We've seen this multiple times. A single rumor of YCC adjustments creates instant volatility. Okay, traders around the world watch the BOJ like hawks because they know Japan's monetary policy is so loose that any small deviation can cause huge moves. The JPY is a currency that stays weak for months but crash violently within minutes when policy finally shifts. Okay. Understanding this will help traders anticipate volatility in yen pairs and take advantage of major macro moves. Okay, so super aggressive, slow, and I would say stable, but once there's news, it goes crazy. Okay, so how interest rate decisions move Forex pairs. Let's move into our next part of this webinar. I'm gonna finish today's webinar quickly so that we can move into the Q&A session because I remember last week we did have Q&A session and you guys were asking me questions, but I did run out of time. So maybe today we can finish this quicker and then we can move. If you can elaborate on it, how did you develop fund your strategy for your project? How much practice have you done? Number of tests of years, how are you using the same strategy for the small project that you used to swing trade? Have you changed it? Okay, good question, Dula. I think to answer your question, okay, let me just finish all these slides. I only have like 6 more slides to go. I can finish it in the next 10 to 15 minutes, I think. And then I will answer your question about back testing. So, Yula is asking about how did I find my strategy? Um, how much did I back test? Number of tests or years back? How are you using the same strategy? Okay, so yeah. I'll come back to that in a bit, but thanks for asking. Okay, so the interest rate decisions are the backbone. Right. Yeah. So I've got another question here. I will answer that right after I'm done with this slide so that we can just purely focus on the Q&A. Okay, so let's move on to why Forex reacts instantly to interest rate changes, like the yield. So it's called the yield advantage. Okay, so the interest rate decisions are the backbone of every major Forex move. The reason is simple. Currencies are yield-bearing assets. When a central bank raises interest rates, the currency becomes more attractive because investors earn more by holding it. Think of it like savings account. If one bank offers 0.5% and another offers 4%, where would you keep your money? Obviously at the 4% bank, right? So Forex works the same except multiplied on a global scale with trillions of dollars involved. Okay, so when the Fed, ECB, or BOJ adjust rates, traders immediately shift capital towards currencies offering better returns. So here's where it gets even more interesting. Okay, so Forex doesn't react to the current interest rates. Forex reacts to where rates are expected to go in the future. This is why sometimes a rate hike can still cause a currency to fall. If the market expected 50 BPS hike, but the central bank only delivered 25 BPS, traders may see it as dovish and sell the currency. This is also why rate differentials matter more than individual rates. For example, if the Fed hikes faster than the ECB, USD gains against the EUR. But if both banks hike at the same pace, EUR USD may not move at all. So when you trade Forex, you're not trading the rate, you're trading the relationship between the two central banks. So like I said, if we're talking about Forex, we're talking about where the money is moving. Okay, if I have to give you guys my own view, obviously maybe I'm a little bit biased, but I think the Singapore dollar is one currency you guys can consider moving to. The Singapore dollar today is 1.34, or is it 1.43 of the US dollar? Okay, that means for every one US dollar, it equals to 1.34 or 1.43 of the Singapore dollars. I don't know what the number. But by 2040 or 2030, I think it's 2040, which is 15 years from now, they expect the Singapore dollars to be of equal value to the US dollar. Okay, so you know there's one currency that is coming up, and I'm telling you that, and I'm of course obviously I'm biased because I live in Singapore and I have businesses in Singapore, and I do want it to happen. But yes, this is something you guys can consider. Anyways, let's move on to the chain reaction. How rates affect bonds, how it affects yields, and how it affects the currency strength. So when a central bank raises interest rates, the first market to react is usually the bond market. Bond yields move up because investors demand higher returns to hold government debt. Once bond yields rise, foreign investors start pouring money into the country's bond market because the returns are suddenly more attractive. But to buy those bonds, they first need to buy the local currency, and that buying pressure strengthens the currency. By the way, I also hold bonds. Okay, this is why the USD often rallies after the Fed becomes hawkish. US treasuries are considered the safest assets in the world. When their real yields rise, global investors rush in, converting trillions of foreign capital into US dollar. That demand for dollar pushes the USD higher against almost every currency. This same mechanism applies to other currencies too. When the Reserve Bank of Australia hike rates and yields rise, the USD tends to strengthen. When the Reserve Bank of New Zealand tightens policy, NZD usually rallies because investors chase New Zealand's higher results. The opposite is also true. When central banks cut rates, bond yields fall, foreign investors leave, and the currency weakens. This is why rate cuts often trigger sharp decline in the US JPY, GBP USD, and EUR USD, because the yield advantage disappears. Understanding this chain reaction, how rates affect bonds, yields, capital flow, and then currency direction, allows traders to anticipate moves in Forex before the charts even show them. So why rates expectation move Forex more than rate decision? It all comes down to how we decipher hawkish and dovish. So one of the most important lesson in forex trading is this: currencies move based on expectations, not actual decisions. So by the time a central bank actually hikes or cut rates, the markets are already priced in most of it. This is why rate announcements often feel anticlimactic. The big move already happened weeks earlier when traders were adjusting their expectations. What really moves forex pairs is the surprise factor. For example, if the market expects the Fed to cut rates later this year, but Powell suddenly signals that rates may stay high for longer, the US dollar can explode upwards even if the Fed didn't change the rate at all. The tone of the speech, the language used, okay, the and moving forward guidance can move markets far more than actual policy action. So a hawkish pause can be more bullish for a currency than a small hike. A dovish hike can be bearish because it signals that future hikes might not continue. Um, this is why central bank press conferences are sometimes more volatile than the policy release. Traders are scanning every sentence for clues about the path ahead. That's why I don't really like it, because I feel like I would misinterpret it and misunderstand. But the moment the market hears something unexpected, whether it's hawkish or dovish, forex pairs can move violently. Understanding rate expectations is what separates macro traders from technical only traders. Once you understand the psychology and the predictive nature of central banks' communication, you begin to anticipate moves long before they appear on the chart. So if you guys have any questions regarding like forex trading, how to become profitable, whatever, ask me in the chat box. But if your question is, hey Cass, how do I understand their speeches better? I'm going to tell you right now, even I am learning to understand their speeches better. So once I become a master at this, I can teach you, because how I personally became profitable is purely using technical analysis. It's only recently, I've told you guys many times that I used to do a lot of technical analysis webinars for you guys. It's only like a few months ago, Vantage has told me to change my topics to microeconomics, macroeconomics, geopolitical topics, basically anything to do with anything that is not technical analysis, that is economy related, investment related, but not technical analysis. So it's only when I started doing all this research for you guys, then I realized that there is a difference for like the technical only traders, and it really is a difference with the traders who combine macroeconomics and understanding these speeches, follow the news, combining it with technical analysis. I believe traders like this will have a much higher win rate compared to people who are technical analysis only. Because I was already profitable when I was only technical analysis, but now I find that my win rate did increase a little bit when I have started combining fundamental analysis as well. So if your question is, how do you get better at the speeches? You know what? Ask me again in a few months. I'll let you know once I understand what is the secret sauce. Okay. Yeah, but anyways, hawkish means that you favor monetary restraint and increases cash rate. It looks for stable inflation level and contradictory monetary policy stance, versus dovish, where it favors economic stimulus, cut cash rates, looks for stimulating economic growth, and expansionary monetary policy stance. Okay, let's move on to the last part, and then I can quickly go into the Q&A. Okay, so trading high yield versus low yield currencies. Okay, what are the high yield and low yield currencies? The core concept behind carry trade. Okay, first of all, sorry guys, I've been talking nonstop. Sorry, another water break. Okay, When we talk about trading high yield versus low yield currency, we're basically talking about one of the oldest, most powerful strategies in Forex, okay, the carry trade. Okay, so at its simplest, the idea is this. You borrow a currency with a low interest rate, and then you invest in a currency with a higher interest rate. So, for example, one interest rate is doing 0.5%, then you bring it over to a currency that's doing 4%, for example. So you make um, the difference. Okay, so on top of any price movement, you're also earning the interest rate differential between the two. In other words, you're getting paid to hold the trade as long as nothing blows up in the market. High yield currencies are those with relatively high policy rates. Historically, things like US dollar, New Zealand dollars, some emerging market currencies like the TRY, ZARMXN, okay, for example, low yield currencies are the ones with near zero or very, very, very low rates. So traditionally, I mean, the first thing that comes in my mind is the Japanese yen. You know, their interest rates can go to zero, and that's a normal day. Okay. Swiss franc, and at certain times, okay, not all the time, sometimes we're talking about the euro. Okay, so a classic trade carry trade example is something like long AUD JPY. You're effectively borrowing cheap yen and using it to hold Aussie dollars, which offer higher yield. As long as the interest rate gap stays attractive and the market environment is stable, this trade can quietly earn you yield every single day. But here's the key thing. You're not just trading a chart. Hold on, I see a question. Hey, Cass, for later, can we go back to Japan 10-year yield, USD, JPY? Just want to understand the third item there. Things for later. Okay, sure, Nina. Yeah, I'm gonna quickly finish this and then we can do the whatever you guys are requesting. Okay, sorry, where was I? Okay, so the key thing is you're not just trading a chart, you're trading a macro relationship between two central banks. You're saying, I believe the high yield central bank will stay hawkish or stable, and the low yield central bank will stay dovish. As long as the story holds and the risk sentiment is positive, high yield currencies tend to appreciate versus low yield ones. That's why in long periods of low volatility and strong risk appetite, carry trades can be insanely profitable. Okay, but this is big, but when the risk sentiment flips, these trades can unwind brutally fast. We'll talk about that in the next slide. Do you carry? No, I do not carry trade. I don't carry trade. A lot of these concepts are things I understand, but I've not had practice in it as well. Yeah. So carry trades are like a gorgeous sports car, okay? Amazing to drive on a clear highway, terrifying in a thunderstorm. Okay, in calm, stable, risk-on environments, they work beautifully. Stocks are going up, volatility is low, central banks are predictable, and investors are hungry for yield. Okay, that being said, like I said, again, as I'm learning all this when I'm doing all this research to share it with you guys, a lot of times I'm just like, okay, these are things I do want to look into. Okay, but I don't think we are in a um risk on environment right now, to be honest. Okay, I personally think we're in a risk off environment. I could be wrong. But when we are in a risk on environment, I might put some funds aside to try this carry trade, to carry trade. Okay. So stocks are going up, volatility is low, central banks are predictable, and investors are hungry for yield. Under those conditions, traders are more than happy to borrow low yield currencies like the Japanese yen or the Swiss franc and pile into high yield ones. The trend becomes almost self reinforcing. As more people chase carry, high yield currencies stay supported or grind higher, and everyone feels like a genius collecting daily swaps. But the dark side of carry trade shows up the moment something goes wrong. A black swan event, for example. Okay, a surprise central bank decision, geopolitical shock. Okay, well, I mean, then again, all this stuff will scare everyone. It doesn't have to be someone who is doing carry trade, right? I did tell you guys that I lost 100,000 in 3 days. Did I tell you guys that? In I don't know what year when Russia decided to bomb Ukraine, I lost like 100,000 in 3 days. Okay, 3 days. That's like 72 hours. Okay, so geopolitical tension will attack anyone. It's not just people who do carry trade. Okay, so the moment markets switch off risk on to risk off, investors rush to unwind their carry exposure. Okay, that means they start dumping high yield currencies and buying back the low yield funding currencies. And because everyone tries to exit at the same time, the move becomes violent. This is when you see pairs like AUD JPY, NZD JPY, GBP JPY collapsing hundreds of pips in a short time. And that's a classic carry unwind. This is why people say carry trading is like picking up pennies in front of a steamroller. You earn small, steady gains for a long time, and then suddenly, if you're not ready, if you're not careful, one volatility event wipes out months of profits in a few hours. So the real skill in trading high yield and versus low yield currency is not just entering the carry trade, it's knowing when to step aside, when volatility is too high, and when the macro narrative is shifting. If central banks hint at changing directions, if risk sentiment flips, or if you see early signs of stress in equities and credit markets, that's your cue to reduce exposure. Carry trades reward patience and punish greed really, really fast. Okay, let's go into the last part of carry trade. Now, let's talk about what actually apply in your trading in a structured way, not just the, high yield, low yield, bad. A good starting point is this simple rule. You want to trade high yield versus low yield when the world is calm, and you want to be extremely careful or flat when the world is chaotic. In practice, this means you look at things like equity indices. Are they trending up or chasing? Volatility indices like VIX. Is volatility low, compressed, or spiking? And central bank communications. Are they predictable or sending mixed signals? If stocks are gently trending higher, volatility is low, and central banks are steady. That is prime carry trade environment. In that kind of backdrop, you can look for pairs like AUD JPY, NZD JPY, and maybe some emerging markets versus Japanese yen or Swiss franc, and trade them in the direction of the carry, long high yield, short low yield, ideally aligned with the technical trend. You don't have to overcomplicate it. You're basically riding the macro wind that's already blowing in your favor. But even then, risk management is everything. Position sizes should be reasonable, leverage should be controlled, and stop losses should be placed beyond short-term noise but within your risk tolerance. You're not scalping here, you're swing trading a macro theme. So on the flip side, when the big events are coming like CPI, FOMC, central bank meetings, geopolitical headlines, or when risk sentiment turns shaky, that's when you either reduce exposure or you stand aside. Okay, so that's all I have for you guys today. Let's do the Q&A session. Okay, let's do Nina's one first before I answer any question. Can you go back to the JPY 10 yield? JPY 10 yield. Okay, there you go. Okay, so the third item there. So the third one of the only dovish, one more, the other JPY chart. Which JPY chart? I think JPY is in our second subtopic, right? This is Eurozone. So this is Fed, Eurozone, and then we've got JPY. I mean, BOJ. JPY chart. Okay, is this the one? Yes, okay. Uh, give me a moment. Which, is there anything you need me to explain to you, or do you just need to take a photo of this? Okay, so I got this picture from this Google, and I just saw whatever is most relevant. Okay, so this moving average is just, I don't know why they chose to use 55 moving average, but it's basically saying how, okay, you can see the USD yen, right? USD JPY. Okay, sorry, I do know why they're using the 55 moving average. I guess they're using the 55 moving average more like a natural moving average. I'm not sure if you understand how natural moving average works. So natural moving average is where you, the trader, um adjust the settings according to how the market is moving versus like your usual like 100 moving average, 50 moving average, or 200 moving average. Okay, so in this case they use the 55 moving average. Let me take out my laser pointer. Okay, so this is the 55 moving average, this blue line here. Okay, they're showing you that the price of the USD yen was respecting nicely under the moving average until it finally broke here, where we can see both the US 10 and the moving average, sorry, the the yen, the USD yen and the US 10 T bonds met here and broke the moving average together. Okay, so there was a bit of alignment happening here. But basically it's just showing how um price was respecting this part here. Yeah, that's right, Brian. That's right. There was probably interest rate changes here. That's why there was a break of that moving average. No worries. Thank you. Thanks for asking. Thanks, Brian, for your input as well. Okay, let's move on to the next question. I've got a question here from Gula. Can you elaborate um how did you develop your strategy? How much back testing have you done and the number of tests and years back? Okay, so to answer this question, I do need to pull up trading view. Let's see if I can pull up trading view. Hold on. Let me see if I can pull up trading view. Give me a minute. guys. You guys, I'm using dual screen, so like this I have a lot of because we're streaming on so many platforms, I have so many like things in my on my screen. I cannot even tell where my Google is. Okay, there you go. Okay, so how do I backtest? I first decide a strategy that I want to backtest. So trading strategy. Okay, let's randomly choose one. Okay, I'm just randomly choosing one. Swing trading masterclass. Okay, this guy is trying to sell you a course. Sorry. Let me randomly 30 best trading strategies. Okay, so I'm just randomly choosing one. I don't know why my browser is Yahoo. Okay, it's usually is everyone trying to sell a course? Okay, forget it. No one's really giving a good one. Okay, let's say I decide to do a breakout strategy. Okay, I'm trying to play a breakout strategy. How do I backtest it? I backtest it 100 times on the time frame that I choose. Okay, so in this case, you need to decide if you want to be a swing trader, a day trader, or scalper. Then you can decide the time frame that you're going on. Okay, so then I decided that I want to be a swing trader because I don't want to spend so much time staring at being on the screen. So a swing trader usually looks at the 1 day and then the 4 hours. Okay, so then now I've decided I'm going to use a back testing strategy, right? So what is, sorry, not back testing strategy, a breakout strategy. So am I going to use my breakout strategy? So I'm going to identify a zone where price has been consolidating for a while. Okay, so this part is a very good example. Okay. This part is a very good example. So my breakout strategy is every time I find a area where price is consolidating, for example, okay, it's consolidating within this box. So it's doing this, right? We can all agree that it's doing that. Okay, so when my breakout strategy, this is just an example, okay? This is not what I actually use. This is just an example. Okay, so if price breaks to this side, I'm going to enter for a buy. If price breaks to this side, I'm going to enter for a sell. And then I'm going to put my stop loss here before the breakout and my take profit at the next zone. So if we break out here, my next zone is this next swing high. Okay, or my next zone for the sell is this next swing low. Okay, this is my take profit. Okay, whatever it is. So then I'm going to test this out 100 times to see if it works. This is my first example. If it works, then I'm like, okay, I'm going to try again. So then I go back and I try again. Okay, I see price consolidating here too. Okay, this is not a good chart to play the breakout strategy because price is not really going sideways. It's just choppy. Okay, so you see how when I back tested this, I realized that the breakout strategy would not work very well for this. Therefore, that I'm just like, okay, this is not working out. Let me try XAU-USD, for example. I think XAU-USD would be a better breakout. See? Okay, so price is going sideways. We can all agree price is just moving within this area. If it does a breakout, I'm going to enter here for a buy. If it does a breakout here, I'm going to enter for a sell. Okay, so this is one example. And then I'm just going to, if this works out, then I will tell myself, okay, that's 1 out of 100. Correct. And then now I pull back again and I look for another consolidating zone. Okay, so yeah, price is consolidating here, for example. Okay, so we can see price going sideways. If price breaks out here, I'm going to enter for buy. If price breaks out here, I'm going to enter for sell. If that works out, then I'm going to give myself 2 to 100. So once you are done back testing, right? You are done back testing. Now you find your next one. Your job is like, okay, so my job as a trader now is just to wait for price to go sideways. And then once it goes sideways, my job is to wait for a breakout. That's it. That's all it is. But if price is going up, it's raging upwards, then I have no trade because when price is going up or going down, it's not my strategy doesn't work in this market condition. So then you back test enough to see what strategy works on what market condition and what chart and what time frame, and then you can use that on your time frame. So I'm going to say this, a lot of people are not making money in trading because they're not putting in the time to back test. Okay? It's the same in every industry, in everything. It doesn't have to be trading. If you are an athlete and you are not winning in your game, it's probably because you are not training enough. Okay, so I'm going to be very honest with you guys. If you are not profitable in trading, there can only be one reason. You are not using the correct strategy and you are not back testing enough to see if that strategy works. So what do? You need to test the strategy. You need to test the chart that that strategy is going to work on. You need to check you need to choose the time frame. You need to keep trying and trying and trying until you finally find a strategy that works on a particular time frame, a particular pair. Okay, so I've already done the work. That's why I'm profitable because I know what strategy works for what time frame and I know what strategy works for what pair because I've already put in the work to do it. Okay, so for gold, I actually don't use this strategy. I actually use Ichi. I actually use Elliott wave. So for those who don't know Elliott wave, it is basically a strategy where price moves in 1, 2, 3, 4, 5, followed by ABC. And with these strategies, I can predict where price is moving. Not predict, but forecast where price is moving because I know Elliott wave works really well for XAU USD. But if I go to another pair, if I go to USD JPY, for example, if I go to USD JPY and I pull out Elliott wave may not work on USD JPY. I don't know if it will because I have not back tested Elliott wave on USD JPY. I have back tested Elliott wave on XAU USD. I have back tested Elliott wave on ETH USD and it works really well. But it does not work very well on Forex pair. I have tried it on EUR USD. It does not work very well. So EUR USD, I have a totally different strategy for EUR USD. You need to choose your strategy, you need to choose your pair, and you need to choose your time frame, and then you need to backtest. If you are not making money from trading, it's the only reason could be is that you are not backtesting enough. Okay? So practice makes perfect. Yes, it will take you a lot of hours, it will take you a lot of days. How long did I take to master Elliott wave? I think close to 1 year. Close to 1 year of practicing it every single day. Okay. That's how I got so good at making money from XAU USD and ETH USD because I practiced it every single day with Elliott Wave until I got good at it. Okay, so that's how much I backtest. Are you now using the same strategy for smaller accounts? And yes, you can use the same strategy. Once you find a strategy that works on whatever time frame and whatever pair, it will work on no matter what account size. Because when it comes to account size, it is just risk to reward, right? It is just adjusting your lot sizes and your risk. It's just risk management. That's a totally whole different ballgame. It's just a totally different part of becoming profitable. But I have to tell you, backtesting is a very big part of being profitable. Risk management is a very big part of being profitable, but backtesting is a very big part of being profitable. Okay. I hope that answer your questions. Have you changed your strategy yet? Nope, I have not changed my strategy because as of now, it is still making me money. If one day it stops making me money, then I will sit on my chair again. I will look at the computer again. I will put in the time and I will backtest again. But at this current point of time, whatever I've been using is still making me money. So I'm going to keep using it until it stops making me money. And then I will have to go back to the drawing board again. Okay, so I hope that answers your question. I've got Oh yeah, I've answered that already. Okay, so do you guys have any more questions? If not, I'm going to end today's webinar. We are a bit overshot. You see, like when I talk about technical analysis, I can talk for like hours because I specialize in technical analysis. Are you t using TV free? Oh yeah, yes, I'm using the free account. I'm not even using the paid one, because there's no point. So I used to pay it to use this replay function. You know how replay you can go backwards and then yeah, see? So if you use the replay function, you can just crop and then pretend the past didn't. This really helps a lot for backtesting. But then I realized like, okay, I don't really need that. I'll just pretend this part doesn't exist, right? If I'm gonna focus on this part, I'll just focus on this part and I'll just pretend this part doesn't exist. Okay, but I used to pay for TradingView, but I just like, do I really need to pay for TradingView? I don't really need to pay for TradingView. Okay, so that's all I have for you guys today. Thanks for staying till the end of the webinar. Thanks for those who are on Zoom. Thanks, Eula, Helen, Kirsten, Nina, Tiffy, Brian, Joash, Bob, Muhammad, Kristen, Christ, Jeremy, Ming, and thanks for the 1,200 of you on Vantage app. There's always a lot of you on Vantage app. And yeah, you know what? If you guys want to communicate with me, better communication, those who are on Vantage app, just join the Zoom link, because the communication on Zoom is way, way, way easier. Okay, you guys who are on Vantage app, there's 1,300 of you fighting to talk in the chat. That's why it's so hard for me to answer you guys. Okay, so bye guys. Take care. Take care. I will see you guys next week. I wish you can teach us technical analysis. I used to teach you guys technical analysis, and then Vantage requested for me to teach you guys fundamentals. Okay, so sorry about that. Okay, bye guys. Take care.